Chapter 4, Typical Parameters for Intermediate Trends. Some basic observations. The two previous chapters discussed the main or primary trend, that is, the price movement that corresponds to changes in economic activity over the course of a typical 3 to 4 year business cycle. Though it is clearly important to have an idea of the direction and maturity of the primary trend, it is also helpful to have some understanding of the typical character and duration of the intermediate trend for the purpose of improving success rates in trading and also to help assess when the primary movement may have run its course. This chapter focuses on intermediate trends in the US stock market, but the principles outlined here apply to any freely traded entity. Successful analysis of intermediate trends for any market or stocks offers the following advantages. Number one, changes in intermediate trends aid in identification of turning points in the primary trend. Number two, intermediate term trading involves fewer transactions than trading of minor price movements and therefore results in lower commission and execution costs. Intermediate trend reversal points occur several times a year and can, if properly interpreted, allow a relatively high and quick return on capital. Intermediate cycles defined. A primary trend typically consists of five intermediate trends, three of which form part of the prevailing trend, while the remaining two run counter to that trend. In a bull market, the intermediate counter trends are represented by price declines. In a bear market, they form rallies that separate the three intermediate down waves, as shown in Figure 4.1. It is apparent from this discussion that there are essentially two types of intermediate price movements. The first, which goes in the direction of the primary trend, may be called a primary intermediate price movement. The second The second is an important price movement that lasts from 3 weeks to 3 months, occasionally longer. It normally retraces between one third and two thirds of the preceding primary intermediate trend. This price movement, which runs counter to the main trend, is called a secondary movement or reaction. Since the primary intermediate price movement operates in the same direction as the primary or main market trend, it almost always lasts longer than its secondary counterpart. Its price magnitude is normally much greater as well. These countertrends or reactions against the main trend are notoriously difficult to forecast in terms of character, magnitude, and duration. Therefore, they should generally be avoided from a trading point of view, as they will almost invariably be subject to confusing whipsaws. By their very nature, they tend to fool the majority and are usually extremely treacherous. It is possible to design successful mechanized systems based Figure 4.1 intermediate cycles in a primary trend. Primary intermediate price movement, secondary reaction. By their very nature, they tend to fool the majority and are usually extremely treacherous. It is possible to design successful mechanized systems based on intermediate price movements, but poor or losing signals usually come from secondary market movements that occur against the main trend. Intermediate term trends that move in the same direction as the primary trend are generally easier to profit from. Those who do not have the patience to invest for longer term will find that successful analysis of intermediate movements offers superior results, especially as the day to day or minor swings are, to a large degree, random in nature and therefore even more difficult to capitalize on. This tendency has been most pronounced in recent years when increasingly sharp prices price movements have resulted from emotional knee jerk reactions to the release of unexpected economic data. A secondary reaction does not have to be a decline in bull market or a bear market rally. It can also take form of a sideways movement or consolidation under the same idea as Charles Zhao's line formation. See the discussion in chapter 3. Intermediate movements can go either with or against the main trend, which means that there is an intermediate cycle similar to primary one. An intermediate cycle consists of a primary intermediate price movement and a secondary reaction. It extends from a low on one intermediate trend to the low on the other, as shown in figure 4.2. In a bull market, the up phase of the cycle should be longer in time and greater in magnitude. The low on the secondary reaction should be higher than its predecessor. In a bear market, the reverse condition hold. Figure 4.2 Intermediate term cycles. The low on the secondary reaction should be higher than its predecessor. In a bear market, the reverse condition hold true, that is, declines are longer and greater, while rallies are shorter and sharper, but of less magnitude. Accordingly, technicians are alerted first to the possibility of a reversal in primary trend when a third intermediate cycle is nearing completion. It is also important to note whether the overall technical structure looks weak, strong in a bear market as the previous intermediate low or high is approached, and finally to note whether that level is decisively broken on the downside or upside. This does not mean that primary movements can never encompass more or fewer than three primary intermediate movements, for often they do. Expect three as a normal event, but do not be caught off guard if there are fewer or more. Causes of secondary reactions. Since the primary trend of stock prices is determined by the attitudes of investors to the future flow of profits, which are in turn determined to a large degree by the course of the business cycle, it would seem illogical at first to expect longer term movements to be interrupted by what often prove to be very uncomfortable reactions, or in the case of a bear market, very deceptive rallies. History shows that secondary reactions occur because of technical distortions which arise in the market as a result of over optimism or over pessimism, and also because new factors emerge that suggest business conditions are not going to be as extreme as was originally anticipated, or even that they are going to materialize in the opposite direction. For example, after the first intermediate term rally in a bull market for equities, a reaction may develop because investors who had discounted a strong recovery now see some chinks appearing that might even forecast an actual decline in business conditions. Such fears eventually prove ungrounded but are sufficient to cause a countercyclical intermediate reaction. Such fears eventually prove ungrounded but are sufficient to cause a counter-cycle in intermediate reaction. Another possibility might be a fear of rising interest rates, which could choke off the recovery. Since prices had discounted a strong recovery, this change in perception causes investors to pull back and prices to fall accordingly. At the same time, many investors get carried away during the rally phase and leverage themselves up. As prices begin to fall, this causes their equity to shrink and forces them to liquidate, which adds further fuel to the price decline. A bear market rally for stocks generally takes place because of an improved outlook for business conditions over what was anticipated. A bear market rally for stocks generally takes place because of an improved outlook for business conditions over what was anticipated. A bear market rally for bonds develops under the opposite set of conditions. Correction in commodity and currency markets all have their roots in a changed but incorrect perception of the underlying primary economic trend. The catalyst for the rally is the rush by traders and investors to cover their short positions. For a definition and explanation of short selling, see the glossary. It should be added that the apparent motivating force for the correction need not necessarily be directly linked to the outlook for business interest rates. Major technical principle. At any one time, there are four influences on price. They are psychological, technical, economic, and monetary in nature.